Welcome to 10-8 Explained. This question itself goes through basically everything we've covered in the last few chapters, from a 6-column worksheet to generating an income statement, a statement of changes in owner's equity, and a balance sheet. It then goes into journalizing closing entries, posting those closing entries, and then preparing a post-closing trial balance. I'm going to assume, number one, that you know how to do a worksheet, the 6-column worksheet, extending the revenue and expenses over to the income statement and everything else, all permanent accounts plus the withdrawal account over into the balance sheet columns. And then you're going to find out that we have a net income. I've taken that information and I just plugged it right into the income statement. This is not giving away the store here. I'm just figured to save a little time explaining it. So I've taken all the revenue, put all the subtotals here, put the total right in here where it says total revenue. So use that right-hand column. This is not a debit and credit situation. This is what is being added and what the total is. What is being added and what the total is. So that you know that you have $13,100 in revenue and $4,575 in expenses. The difference between that is $8,525, giving you a net income. Important information. Trust me, it's important. So we'll put a little triangle next to that. Where do we start getting into the weeds? When we start dealing with the statement of changes in owner's equity. It's asking the very first question it asks. What is the beginning capital balance, right? Beginning capital balance. What date? December 1st. We know that the report is being generated on the 31st, but we want to know that during the course of the month, what affected that capital? What led us to the balance of $33,000, right? So let's put that number there, $33,775. That's the ending, that's the trial balance capital balance, right? I should say it's the capital balance in the trial balance. So, what affected this during the month? What went into that? Well, look at the question. This is where we sometimes don't want to read, right? So $10,000 was added into the business by the owner during the course of the month. So sometime between December 1st and December 31st, 10 grand went in there, and that's where we got to that $33,775. Simple as that. So we need to, if this is the end, and this is the during what happened, right? The additional 10 grand, that tells you that the beginning balance is going to be $23,775. So let's plug it in. $23,775. Well, what other things affected this? Well, this is where we do our additions. The first one's going to be investment by owner. And we've already established what that was. $10,000. So put that right here. Again, we're using that right-hand column because we're going to be adding something along with that. The other thing that it positively affected the beginning, the capital, was the net income. And that was how much? Well, we have it right here. $8,525. The total increase is going to be these two numbers added up. So that would be, if my math is correct, $18,525, giving us a subtotal for the capital to be, well, add these two up, right? So we're going to come up with $42,300. Now, what gets subtracted from that? Well, it's going to be less what? Well, it's going to be less the withdrawals. Withdrawals by owner. And what was the withdrawal by owner? Just look. It tells you right there. $4,000. What is the ending capital balance? Because you're going to need this. Well, what is the total? We have, and we'll just put a line there, 42,300 minus the $4,000, which is going to give you $38,300. That is the ending capital balance December 31st. You're going to need that for the balance sheet now. Let me pause the video and call some more documents up. Okay, we're going to do the balance sheet now after we've finished the statement of changes in owner's equity. We know that there's only going to be 3 categories and only permanent accounts are listed. So some of the information we just gleaned from the statement of changes in owner's equity will come into play, but that's the very last thing we plug into these numbers. So we're going to look at the actual trial balance from the 6-column worksheet, and we're going to take the accounts that are over here and we're going to move them into the trial balance. So just for starters, I will go, assets are going to stop right here. Let's see, there's the payables, right? These are all the assets, and they're going to get plugged into the asset side. You can see 1, 2, 3, 4 different liabilities. Oops, get rid of that, capital. That's going to go into the liabilities. And then we need to plug in the number for the capital. So we would say, and this is a drop-down menu, I understand, for you guys, so you should be able to figure that out. The capital here is going to come from, and this is a printed version of what the statement of changes in owner's equity looked like. We determined that that was going, at the end, was $38,300. That was this number right here that we had generated. So this is the statement of changes in owner's equity, beginning capital balance with the effects of the investment and the net income with the withdrawal, leaving us with $38,300. So let's get that to go away. Boom. Plug that number in down here so we don't forget it. And then we're just going to transfer all this information from the assets and liabilities right into the balance sheet. So give me a moment. Okay, this is the balance sheet. We've transferred the numbers from the trial balance, and we've put the number that we had generated off of the statement of changes in owner's equity in the Greg Falla capital number, the 38,300. And as always, assets equals liabilities plus owner's equity. So if you take the sum total of all the assets, you're going to come up with 71,200. If you take the liabilities of 32,900, add that to the ending capital balance that we gleaned from the statement of changes in owner's equity, that's going to give you $71,200. Does it balance? You're going to say yes, it does, and that makes us a very happy camper. That finishes the balance sheet side of it. Okay, the next thing it's asking you to do is to journalize the closing entries. I have taken the liberty to draw out the T accounts as we analyze the list of transactions. From these T accounts, you're going to be able to both journalize and post. Okay, if you don't journalize them correctly, your posting is going to look like a hot mess. So let's go right by the numbers here. Okay, we're going to close the revenue accounts as always first, and they get closed into the income summary. Very good. And we have 2 revenue accounts, so we have a compound transaction going to go happen here. So we have a $9,600 balance in the credit, so we can need a $9,600, and there's 1, and a $3,500, and there's 1, right? Here's our closing entries. The sum total of the revenue accounts is $13,100. $13,100, so that equals, and that's the case. Here's our debits. Journalize those first, and then go to our credit. And that closes our revenue accounts. Expense accounts. We have how many? 1, 2, 3, 4, 5. 5 different expense accounts. It's a compound transaction. And the total of all the expenses, the total for all of the expenses is going to be, to make sure I get this correct here, total for all of the expenses is $4,575. You can take a moment. 1,600, 1,200, 400, 1,000, 375. Now these are all part of the second closing. These are going to be all of your credits. The sum total, which is going to be your debit, that's going to go over here. $4,575. That closes your expense accounts. The third account that gets closed, I guess we should put expenses up here, is the income summary, right? And what does that get closed into? The capital. And we'll just, for the sake of not having to forget, we'll put that withdrawals go into the capital. So we're doing the third one right now. Income summary. Well, what is the balance of the income summary as of this moment? Well, that would be the difference between $13,100 and $4,575, giving us a balance, and we'll put it in a rectangle, of $8,525. Sound familiar? Okay. Which means if we're going to close out the income summary with a debit balance, a credit balance of $8,525, we're going to need to do a transaction on the debit side, $8,525. There is the third closing, and if that is our debit, we're going to put that balance of it in the credit. Last account that gets closed is the withdrawal account. It had a debit balance of $4,000, so here is our fourth account closing, and the balance of that credit goes in to the debits. Okay. Now we need to figure out what the capital balance is going to be, just to confirm, because when you do your general ledger, you want to make sure that after your post-closing trial balance, everything is correct. Let's put it that way. So your capital balance is, let's use the calculator here, $33,775. Add $8,525 and subtract the $4,000 gives you a balance of $38,300. That's our capital balance. All of the temporary accounts are closed. So there you go. You journalize each one of these transactions in order, then you post them in order, and then you should have all of your balances. Now, the balance that we need to be concerned with right now in order to do a post-closing trial balance is the capital balance. We're going to take this $38,300 and we're going to apply that in the post-closing trial balance. Give me one moment. Okay, it's time to wrap this question up. The post-closing trial balance, it's a lot easier said than done, but we're going to move through it very quickly. The only number that we really need to be concerned with right now that is going to be any different than the trial balance is going to be that new capital balance that we had generated. Remember that new capital balance when we were over here, all the closings and how it affected it? It came out to $38,300. That is our new capital balance. So we could go right down immediately to that column and put $38,300. And that is the only thing that's different than what's on over here. Now, we do know that, number one, we don't have withdrawals. Anything with a temporary account, and that's everything from here down, is not going to be on the report. This number's been changed, and then that means everything else you see here is going to be listed accordingly. 12,000, 3,000, 900, 1,800, 1,500, 5,000, 8,000, and the 8,000, 10,000, 20,000, and the last asset is going to be 9,000. If you were to add up all of these numbers, all of the assets, you're going to come up with $71,200. Now we take the liabilities. 400, putting in proper column, right? Debit. 1,550, 1,500 I should say. 3,000, and 14,000. If we add up the liabilities plus the owner's equity, we're going to come up with $71,200. And that is our post-closing trial balance, which is all of the permanent accounts with their balances. All the temporary accounts have been zeroed out. We're starting a new accounting cycle with zero balances in our temporary accounts. So there you go, folks. I guess the last question is asking you, what is the total of the receivables on December 31st? Well, look at your 6-column worksheet. Or, better yet, just look right here. 6-column worksheet or your post-closing trial balance. Let's take your receivable. That's a receivable. That's a receivable. That's a receivable. That's a receivable. Take these 4 numbers, and you would say your receivable balance as of 12/31 equals, and I'm going to let you do the math. That ends 10-8. That is 17 minutes and 29 seconds, a bit lengthy, but I'm hoping that was helpful to you. It's going to take you a lot longer to actually do the problem because I did not do the journaling for you, I did not do the posting, but I did draw it all out. The answers are there. So do well, be patient with yourself, and you'll get it done.